Ever wondered how businesses keep track of their financial health? It comes down to a magical formula known as accounting equations. These equations are the backbone of financial stability, acting as a barometer for a company's economic standing. Even if you're not a finance whiz, having an understanding of these equations can be a real game changer. They're not just number-crunching tools, they're the language of business stability and growth. Intrigued? Stay tuned as we unravel the mystery of accounting equations. Scene script: dive into the world of debits and credits, assets and liabilities. Let's start with the backbone of the accounting world, the basic accounting equation. Assets equal liabilities plus equity. Like an unbreakable law, this equation must always balance, serving as the foundation for all financial accounting. First, let's talk about assets. They are the resources owned by a business, the things that provide future economic benefits. Assets could be tangible, like cash, inventory or property, or intangible, like patents or trademarks. Next, we have liabilities. These are the financial obligations or debts that a business owes to others. Liabilities can be short-term, like accounts payable, or long-term, like a mortgage on a building. And finally, there's equity, also known as capital. This is the value that would be returned to a company's owners if all the assets were sold and all the debts paid off. Equity is essentially the net assets of a business. It can increase through business operations like selling products or through owner contributions like when the owner invests their own money into the business. Now let's put it all together. The basic accounting equation tells us that what a business owns, its assets, must equal what it owes, its liabilities, plus the owner's stake in the business, the equity. This equation is the cornerstone of double-entry bookkeeping, a system that ensures every financial transaction is recorded twice, maintaining the equilibrium of this equation. For example, if a business borrows £50,000 from a bank, its assets, cash, increase by £50,000 and its liabilities, bank loan, also increase by the same amount. The accounting equation remains balanced. Likewise, if the owner invests £20,000 into the business, the assets increase by £20,000 and the equity, owner's investment, also increases by £20,000. Again, the equation remains perfectly balanced. Remember, every financial transaction affects at least two of these components. It's like an intricate dance, where every step, every move is meticulously choreographed to maintain the harmony and balance of the business world. Let's dissect the principles that govern these equations. At the heart of accounting equations lies the concept of the double-entry system. It's a principle as old as the hills, having its roots in the 15th century, and yet it's as relevant today as it was back then. The double-entry system is the backbone of modern accounting. It's based on a simple yet profound idea. For every debit, there must be a corresponding credit. This principle ensures the accounting equation remains balanced. So what does this mean in practice? Let's say a company buys a piece of equipment worth £5,000. This transaction impacts two areas of the company's balance sheet. On one side, the company's assets increase by £5,000 due to the addition of the new equipment. On the other side, if the company paid cash, the cash account, another asset, decreases by the same amount. If the company took out a loan, its liabilities increased by £5,000. Either way, the accounting equation remains balanced. This double-entry system is like the checks and balances system in a democracy. It ensures that every financial transaction has a corresponding impact elsewhere in the company's accounts. This principle provides a comprehensive picture of a company's financial health and helps prevent errors or fraud. But it's not just about keeping things balanced. It's also about understanding the consequences of each financial decision. Every transaction, whether it's purchasing new equipment, paying off a loan, or even just buying stationery, has a ripple effect on the company's financial position. These transactions affect not just the cash at hand, but also the company's assets, liabilities, and equity. Understanding these principles allows us to see how a company's financial position is always in a state of flux, with every transaction causing a ripple of changes across its balance sheet. And it's these constant changes that make accounting so dynamic and exciting. With every transaction, there's a ripple effect on the company's financial position. It's time to see these equations come to life. Let's imagine a scenario where a business owner, let's call him John, is running a retail store. John's business is booming and he decides to purchase additional inventory. He spends £500 on this inventory, paying in cash. In this transaction, John's assets, specifically his cash, decrease by £500, but his other asset, inventory, increases by the same amount. So even though the composition of his assets has changed, the total value remains the same. This is the accounting equation in action. Assets equal liabilities plus owner's equity. Now let's say John makes a sale. A customer walks into his store and buys a jacket for £100. This transaction increases John's cash assets by £100 and decreases his inventory by the cost of the jacket. But again, the total value of his assets remains unchanged. The accounting equation holds. But what happens when John has to pay his store's electricity bill? He pays £200 out of his cash assets. This time his total assets decrease by £200. But this decrease is balanced by a decrease in his liabilities, specifically the amount he owes to the electricity company. Again, the accounting equation holds true. His assets still equal his liabilities plus his equity. Now suppose John decides to take out a loan to expand his business. He borrows £1,000 from the bank. This transaction increases his cash assets by £1,000, but it also increases his liabilities, the amount he owes to the bank, by the same amount. Once again, the accounting equation holds. His assets, now increased, still equal his liabilities plus his equity. Lastly, consider John deciding to withdraw some profits from his business for personal use. He takes out £300 from the business. This reduces his cash assets by £300 and also reduces his equity, the value of his ownership in the business, by the same amount. Yet again, the accounting equation remains balanced. These examples illustrate how every business activity affects the accounting equation. Whether John is buying inventory, making sales, paying bills, taking out loans, or drawing out profits, his actions echo in the accounting equation. This equation continually balances and rebalances, maintaining its equilibrium. It's like a scale that always seeks balance, adjusting and readjusting with every business activity. The beauty of the accounting equation is in its simplicity and its fundamental truth. It captures the essence of a business's financial position at any given moment, reflecting the consequences of every financial decision. As you can see, every business activity echoes in the accounting equation. Why does all of this matter, you ask? Well, the significance of accounting equations stretches far beyond the realm of accountants and financial professionals. It's like the skeleton key that unlocks the door to a company's financial health and business decisions. Think of it this way. If you're a business owner, accounting equations can be your best friend. They give you the ability to make informed decisions, helping you understand whether it's the right time to invest in new equipment, hire more employees, or perhaps diversify your product line. It's like having a financial compass guiding you through the often turbulent waters of business. But it doesn't stop there. If you're an investor, accounting equations offer a peek into a company's financial health. They can help you assess whether a company is overburdened with debt, if it's profitably using its resources, or if it's financially stable enough to weather economic downturns. It's like having a financial magnifying glass, highlighting the details that matter most. And lastly, accounting equations ensure transparency in financial reporting. They keep businesses honest, making sure that every penny is accounted for. This transparency not only builds trust with investors and stakeholders, but also ensures that businesses are held accountable for their financial actions. So, in essence, understanding accounting equations is like having a financial X-ray of a business. It allows you to see what's beneath the surface, helping you make informed decisions, assess financial health, and ensure transparency. So, what did we learn today? We started our journey by understanding the basic accounting equation, which states that assets are equal to the sum of liabilities and owner's equity. This equation forms the cornerstone of double-entry bookkeeping, a system that ensures every financial transaction maintains the balance of this equation. We then delved into the principles of accounting equations. We saw how these principles govern the recording and reporting of financial transactions, ensuring accuracy and transparency. We also saw these equations in action with practical examples. From a simple purchase of office supplies to complex transactions involving loans and investments, we saw how these equations help track the financial health of a business. Finally, we discussed the significance of accounting equations. They're not just numbers on a balance sheet, but a narrative of a business's financial journey. They offer insights into a company's financial state, helping stakeholders make informed decisions. Next time you look at a balance sheet, you'll see more than just numbers. You'll see the story of a business,